We start tonight with President Trump's landmark legislation. At the White House this afternoon, he signed the 940-page Big Beautiful Bill into law. The president hailed the achievement, claiming it's the most popular bill ever signed.
Something massive just shifted in the U.S. economy, and it's going to impact almost every part of your financial life. From how you save for retirement to the taxes you pay on your income, even how much you'll leave behind for your kids, everything is being reshaped. On July 4th, 2025, President Donald Trump signed into law the One Big Beautiful Bill Act, better known as the Big Beautiful Bill. This isn't just a minor adjustment to the tax code. It's a sweeping transformation of the system, and the decisions you make in the next few years will determine whether you benefit or get left behind. A new era in taxes and wealth planning, the Big Beautiful Bill is being hailed as the most significant tax reform in over a decade. It extends the tax cuts from 2017 that were set to expire, locking in lower rates and higher deductions until at least 2028. For many Americans, this feels like relief, especially in a time where prices have been rising and every dollar matters. But beneath the surface, this bill is also setting the stage for something much bigger. The Congressional Budget Office projects that this legislation will add over $3.8 trillion to the national deficit over the next decade, increasing the debt-to-GDP ratio by 9.6 percentage points by 2034. While the Tax Foundation estimates a modest 1.2% boost to long-term GDP, the cost is undeniable. With that kind of borrowing, the pressure to raise taxes in the future is almost certain. That means the lower rates you see now might not last. For retirees and investors, this opens up both a golden opportunity and a ticking clock. Roth IRA conversions. For anyone thinking about retirement planning, this is where the bill gets interesting. Roth IRAs have always been a powerful tool because they allow your investments to grow tax-free and your withdrawals to be tax-free in retirement. But many high earners who make too much to contribute directly have been using the so-called backdoor Roth strategy. That loophole is gone starting in 2026. After that, you won't be able to convert after-tax contributions from a traditional IRA into a Roth. For retirees, there's an even bigger play here. The bill introduces a temporary $6,000 senior bonus deduction, $12,000 for couples filing jointly from 2025 through 2028. This deduction effectively lowers taxable income, giving retirees a narrow window to convert traditional IRAs into Roth IRAs at a lower tax rate. Consider this. A retiree in the 22% bracket converting $50,000 would pay $11,000 in taxes today. If rates jump to 24% or even 28% in the coming years, the same move would cost $12,000 or $14,000. Acting now could save thousands. And there's another layer. With no extension of ACA premium tax credits after 2025, health insurance costs may spike. Roth accounts, which provide tax-free income, can help retirees cover those premiums without triggering higher taxes on Social Security or Medicare premiums. This flexibility is invaluable in uncertain times. How these deductions could shape spending and the economy. These new deductions aren't just about helping taxpayers save money, they could also change how people spend. The no tax on tips and no tax on overtime deductions may push more workers to take on additional shifts, knowing they'll keep more of their earnings. Employers in industries like hospitality and retail could also benefit from a more motivated workforce, even if critics say it doesn't fix deeper wage issues. The car loan interest deduction could spark a wave of new car purchases. By limiting it to new vehicles, the government is clearly hoping to boost auto sales and stimulate the economy. While this may help dealerships and manufacturers, it could also encourage consumers to take on more debt than they normally would. Finally, the senior deduction may free up extra cash for retirees. That extra $6,000 or $12,000 deduction could mean more spending on travel, healthcare, or simply daily living. With seniors controlling a large share of wealth, even small savings can ripple through the economy. These incentives show how the bill mixes tax relief with economic strategy, creating short-term boosts while leaving long-term questions unanswered. TRSAs, the next generation of retirement accounts. As Roth IRAs phase out their most attractive loophole, the bill introduces something entirely new: the Trump Retirement and Savings Accounts, or TRSAs. These accounts are designed to encourage investing in the U.S. economy. There are no income limits to contribute, and the federal government will deposit $1,000 into a TRSA for every baby born between January 1st, 2025 and December 31st, 2028. Individuals can add up to $5,000 of after-tax income to a TRSA each year, but the investments are restricted to index funds tracking the U.S. stock market. This creates a structured, long-term growth vehicle that aligns with the bill's broader economic goals. A $1,000 government contribution at birth, invested at an 8% annual return, would grow to $4,000 by age 18, $10,000 by age 2030, and over $148,000 by retirement at 65. Shaping the future of estate planning. For wealthier households, the Big Beautiful Bill raises the estate tax exemption to $15 million per individual. This increase gives high net worth families more room to pass assets without incurring taxes. But there's a catch: traditional IRAs are still taxable when inherited. Converting those accounts to Roth IRAs during this favorable tax window ensures that heirs receive tax-free assets, an especially powerful move given the Secure Act's rules on inherited IRAs. Roth conversions now not only reduce future tax burdens, but also create a legacy shielded from government grabs. For those thinking about generational wealth, this may be the most important planning opportunity of the decade. The controversial cuts to Medicaid and SNAP. While the bill is generous to investors and retirees who plan carefully, it's far stricter for low-income Americans. Medicaid faces $800 billion in cuts over the next 10 years. Coverage isn't going away, but eligibility rules are tightening. Adults without children must work at least 80 hours per month to stay enrolled, and proof of income and residency will be required twice a year. Missing deadlines, even by accident, could result in losing coverage. The Congressional Budget Office warns that up to 12 million Americans may lose healthcare access as a result. The Food Assistance Program SNAP also comes under stricter rules. Benefits will now adjust more slowly for inflation, and adults aged 18 to 55 with no children will need to work at least 80 hours per month to qualify. Supporters argue these measures encourage work and self-sufficiency, but critics fear millions could lose vital assistance. Energy policy. The Big Beautiful Bill also reshapes America's energy strategy. Funding is shifting away from green energy initiatives and toward oil, gas, and nuclear power. Supporters say this will boost domestic production and lower costs in the long term, but it also means fewer tax credits for solar panels and energy-efficient upgrades. States can even impose additional fees on utility bills if usage exceeds a set limit, a hidden cost for heavy energy users. Car loans and child tax credits. For those buying new cars, the bill introduces a tax deduction for interest on car loans, but only if the vehicle's final assembly was in the United States. The deduction is capped at $10,000 annually, and analysts estimate average savings at less than $500 per year. It's helpful, but hardly transformative. Parents get a modest bump in the child tax credit, which rises from $2,000 to $2,200 per child starting in 2025. From 2026 onward, the credit adjusts for inflation by 2 to 3% annually. However, about 17 million children won't see the full benefit because their families don't earn enough to qualify. The truth about Social Security taxes. Perhaps one of the most debated aspects of the bill is Social Security. On the campaign trail, President Trump promised to eliminate taxes on Social Security benefits. After the bill passed, the White House declared that promise fulfilled, claiming the legislation means no tax on Social Security. But financial experts tell a different story. According to U.S. News and World Report and advisors like Martin Baker of Canby Financial, the bill doesn't actually change how Social Security is taxed. Instead, the administration is pointing to the temporary senior deduction to back up its claim. Corey Peterson, a wealth strategist with Crew Advisors, explains that while the deduction can offset taxes for many seniors, it's not tied directly to Social Security. Jaime Eccles of Plant Moran adds that seniors claiming early benefits between ages 62 and 64 won't receive any extra tax savings from the deduction. The deduction is phased out for incomes above $175,000 for singles and $250,000 for couples, meaning high-income retirees won't benefit fully, and Social Security benefits remain taxable based on combined income formulas. The reality is clear. While some seniors will pay less tax temporarily, Social Security taxation itself hasn't changed. Who really wins? Critics say the big beautiful bill favors the wealthy, and the data backs that up. Households making over $1 million annually see an average 3% boost in after-tax income, about $75,000 per year. The raised SALT deduction cap and changes to itemized charitable deductions mostly benefit high earners. Meanwhile, middle-income earners gain a small advantage. They can now claim up to $2,000 in charitable deductions without itemizing. Borrowing and inflation. The big beautiful bill is bold, but it comes at a cost. With $3.8 trillion added to the deficit, the government is betting on growth to offset the borrowing. But history shows that more debt in a high-interest environment often leads to inflation. More money printing means asset prices, stocks, real estate, and hard assets like Bitcoin are likely to rise. Those who own assets stand to gain, while those without them may fall further behind. How to truly maximize your Roth IRA under the new law. Now that we've covered the new rules, let's talk about how you can actually make the most out of your Roth IRA in this new landscape. The big beautiful bill changes some retirement planning strategies, but the fundamental benefits of a Roth IRA remain powerful. If you understand how to use it now, you can lock in tax-free growth that lasts for decades. Contribute the maximum every year. The most straightforward way to boost your Roth IRA's power is to max it out every single year. For 2025, the contribution limit is $7,000 if you're under 50 and $8,000 if you're 50 or older, thanks to the catch-up contribution. This might sound like a lot, but think about it as buying yourself future freedom. Every dollar you put in grows tax-free, and unlike a 401k or traditional IRA, you won't have to share any of it with the IRS later. Many people hesitate because there's no immediate tax break for putting money into a Roth. But that's exactly the point. You're paying taxes now at known rates to avoid potentially much higher taxes down the road. Over decades, this can mean tens or even hundreds of thousands of dollars in savings. Why flexibility makes Roth IRAs stand out? One thing that sets Roth IRAs apart is flexibility. There are no required minimum distributions at age 73 like with traditional IRAs. That means you control when, or even if, you withdraw the money. If you're lucky enough to not need those funds, you can let them grow untouched for as long as you like. Think about longevity. If your grandparents lived into their 90s, you might too. Medicine keeps improving, and many of us will outlive today's averages. Having a pot of money that continues to grow without forced withdrawals is like having financial insurance for your later years. A gift that keeps giving. Maxing out your Roth IRA doesn't just help you, it can also set up your heirs for success. Because distributions to your beneficiaries are tax-free, you're handing them an asset that can continue to grow even after you're gone. Under current rules, most heirs must withdraw the funds within 10 years, but that decade of growth can add a lot to what they receive. It's a smart way to leave behind something more valuable than just cash. You're passing along a tax-advantaged asset that could help your children or grandchildren reach their own financial goals. Roth IRA rules are good now, but they may not always stay that way. Congress can change contribution limits, eligibility rules, or even tax treatment in the future. With the big beautiful bill already shutting down the backdoor Roth by 2026, it's clear that opportunities don't last forever. That's why maxing out contributions while you still can is so critical. You're locking in today's benefits in case tomorrow's laws are less generous. If you've been on the fence about contributing, this is the time to act. Protecting yourself from higher taxes. Later. Nobody can say with certainty what tax rates will look like 10, 20, or 30 years from now. But with the national deficit ballooning by trillions, it's hard to imagine taxes going down. A Roth IRA helps you hedge against that uncertainty. By paying taxes now and enjoying tax-free withdrawals later, you're protecting yourself from the risk of higher rates in the future. It's the same idea as diversifying your investments. You spread your bets to reduce risk. With a Roth, you're diversifying your tax exposure. Even if other income in retirement is taxable, your Roth withdrawals won't be, giving you more control over your tax bill. Real understanding of your retirement budget. When you look at your Roth IRA balance, what you see is what you get. That's not true with tax-deferred accounts like traditional IRAs or 401ks. Those balances are misleading because you'll owe taxes when you take the money out, and you have no control over what the rates will be. With a Roth, there's no hidden tax bomb waiting for you. You can plan your retirement spending with clarity, knowing that the full balance belongs to you. That peace of mind is worth a lot. Long-term growth, without the stress of timing. People worry about investing when markets are high or volatile. But with a Roth IRA, you're playing the long game. This isn't a one-time bet on the market, it's a decades-long growth plan. Whether the market dips tomorrow or soars next year doesn't matter nearly as much as staying consistent. If you contribute every year, you're taking advantage of dollar-cost averaging, buying investments at many different prices over time. By the time you retire, those ups and downs will have smoothed out, and you'll likely be sitting on substantial gains, all tax-free, emergency backup without the usual penalties. Here's a little-known perk. Because you've already paid taxes on Roth IRA contributions, you can withdraw the contributions at any time for any reason without penalty. This makes a Roth IRA a last resort emergency fund. Of course, you should avoid dipping into it if you can, because withdrawals permanently reduce your tax-free growth potential. But it's comforting to know that in a worst-case scenario, the Roth IRA gives you an extra layer of security. The clock is ticking on contributions. The window to make contributions isn't unlimited. For 2025, you can add funds until tax day in April 2026. For 2026, the deadline is April 2027. This timing gives you some flexibility, but don't wait until the last minute. The sooner your money is invested, the sooner it starts working for you. Even if you can't max out the full limit right away, contribute what you can. Consistency is more important than perfection. Every dollar counts when it's compounding tax-free. Planning ahead for a comfortable retirement, maximizing your Roth IRA now is one of the smartest moves you can make. It's not just about avoiding future taxes, it's about building a secure foundation that you control. Whether it's funding your later years, leaving a tax-free inheritance, or just knowing you've prepared for whatever comes, a Roth IRA gives you options and peace of mind. With the new rules from the Big Beautiful Bill reshaping retirement strategies, don't miss this chance to get ahead. Start contributing, keep it consistent, and watch your future self thank you. The takeaway for your money, whether it's converting IRAs to Roths, contributing to the new TRSA accounts, or adjusting estate plans, the moves you make now will determine how you fare when the tax landscape shifts again. The Big Beautiful Bill isn't just a set of policies, it's a new set of rules for building and protecting wealth. Some will use it to grow their assets and secure their future. Others may miss the window and pay the price later. What do you think? Let us know your thoughts in the comments, hit the like button if you found this breakdown valuable, and subscribe for more deep dives into the money moves that matter most.